My name is Adam Looney. I'm a senior fellow in economic studies here at the Brookings Institution, and I just want tax policy to be a bit more rational. Unfortunately, the Senate bill actually makes taxes much more complicated for some taxpayers, and it creates a lot of new opportunities for more sophisticated taxpayers and well-advised taxpayers to reduce their tax burdens. One of the craziest parts of the bill is a deduction that allows pass-through business owners to deduct 23% of their income before they calculate their taxes. The result is that there are very large differences between taxpayers in very similar circumstances. So just for example, if you take a plumber who makes $60,000 a year, for instance, if that plumber earns wages paid by an employer, he'll pay basically 60% more in income taxes than if that plumber had been a sole proprietor or self-employed. At very modest amounts of income, the tax differences between which form you choose to set up your business and how you get paid lead to very large differences in the taxes you pay and in your after-tax income. For the most sophisticated taxpayers and for the highest income taxpayers, they'll actually have a multiplicity of choices about how to structure their businesses in order to reduce taxes the most. In general, for most people, the preference will clearly be to form a pass-through business and be a sole proprietor or be a partner in a partnership. But at higher income levels, certain individuals will want to form a C corporation. In order to be a C corporation, it's actually not that hard to incorporate. If you already have a pass-through business, like an LLC or an S corporation or a partnership, all you need to do to turn into a C corporation is check a box on a form. We've really never seen the tax rate that applies to wage earners be very different from the tax rate that applied to partners in partnerships or sole proprietors. In fact, that is like one of the key simplifications in our current code. Because wages are taxed the same as income from a sole proprietorship or income earned by a lawyer in a partnership, you don't need to have special rules to determine whether somebody is an employee or somebody is a partner. You don't need to have special rules that try to classify whether their income is from labor or from business. And so we're really in a new era at the federal level. We do have a good example for some of the problems that can arise. In Kansas, taxpayers were allowed to reduce their taxes by about 3% by changing from being a wage earner to being a pass-through business. That change reduced revenues, it contributed to a budget crisis in Kansas, and it was ultimately unwound and repealed. Kansas's experiment was small in the sense that it was a 3 percentage point reduction in the rate that applied to pass-through businesses compared to wages. It applied only to the state of Kansas, only to a relatively small handful of Americans. And this new bill the rate differences are much larger in magnitude and apply to a vastly larger share of the country, and especially to many more high-income taxpayers. Well, the best way to avoid these problems is just to tax all income at the same rate. The Senate and House bills both already provide very generous treatment for business owners, so there's no need to provide them a favorable or unusually favorable tax rate. Instead, if Congress wanted to enact a substantial tax cut, they can just cut the individual income tax rates across the board. And that would eliminate all these sources of complexity, eliminate all of these sources of sheltering and gaming, and it would provide a more general tax cut that would benefit vastly more Americans.